U.S. consumer prices jumped 3.3% in March, exactly in line with forecasts. And yet that number sent a chill through bond markets rather than relief. The reason is what's inside it. Gasoline prices surged 21.2% in a single month, the largest monthly jump since June 2022. Diesel climbed 30.8%, the biggest on record. Those two lines together accounted for nearly 3/4 of the entire monthly CPI increase. The Iran conflict delivered a direct energy price shock, and the March data is only the beginning of its pass-through into the broader economy. The mechanism matters here. When the U.S. and Israel launched strikes on Iranian oil infrastructure, tankers backed out of the Strait of Hormuz almost immediately. North Sea crude had a record high as European buyers scrambled to source supply from Atlantic Basin producers. Brent briefly traded above $100 per barrel. That price spike takes roughly 4 to 8 weeks to fully appear in the data. March caught the first wave. April and May will reflect the sustained disruption, unless the ceasefire holds. That is the fragile pivot. On Tuesday, President Trump announced a 2-week ceasefire conditional on Iran reopening the Strait of Hormuz. Tanker traffic has partially resumed, and oil prices have since pulled back sharply, logging their biggest weekly decline since 2025. But the ceasefire is described by multiple analysts as fragile. If it collapses, the second wave of energy inflation will hit just as the April CPI is compiled. Economists who had expected 2 Fed rate cuts this year have now removed all cuts from their base case. The energy shock has done what no Fed meeting could. It has effectively tightened financial conditions without a single rate decision.
While the oil shock rewired rate expectations globally, UK markets are processing a more specific problem. The FTSE 100 has clocked weekly gains on ceasefire optimism, but the optimism is conditional, and the conditions are narrowing. Energy stocks initially surged on high crude prices, then reversed as oil fell. Banks moved the opposite direction. Higher rates theoretically boost net interest income, and Barclays shares have been flagged by analysts as one of the most rate-sensitive names in the index. Barclays is down roughly 10% since the start of the year, despite having risen 71% over the previous 12 months. That setup creates an asymmetric earnings event. On April 28th, the bank reports Q1 results. If net interest income guidance reflects the new rate environment, where markets now price in no cuts at all, the stock could recover sharply. But Barclays also expanded aggressively into the Middle East over the past year, receiving a provisional Saudi Arabia banking license last October. The conflict has created uncertainty about whether that regional growth story can continue on its original timeline. There is a second pressure point. Oil above $100 per barrel, even briefly, has already shown up at petrol stations and airline fare warnings. If UK consumers retrench, reducing discretionary spending in response to higher fuel and food costs, Barclays faces a hit not from interest rates but from lower transaction fee volumes. Retail football data showed an early Easter boost in March, but analysts have flagged cost of living concerns as the likely dampener going forward. The consumer spending read inside the Q1 earnings will matter as much as the headline profit figure.
UK mortgage rates have risen for 5 consecutive weeks as the Iran war keeps global borrowing costs elevated. 5-year fixed rates, which had been expected to fall through 2026 as the Bank of England cut, are now tracking in the opposite direction. The rate cut timeline that homebuyers and remortgagers were counting on has been pushed back, possibly past year-end. The effect is already visible in housing sentiment. Persimmon, one of the UK's largest house builders, has flagged declining homebuyer confidence linked directly to the geopolitical uncertainty. The Iran conflict is unsettling the UK property market in a way that is distinct from prior slowdowns. It is not a credit event or a domestic policy shift. It is an external shock transmitting through energy prices into mortgage costs. Gulf buyers have shown interest in the Scottish property market, suggesting that capital from energy exporting regions is flowing toward perceived stability, but that interest cannot offset a broad pullback by domestic first-time buyers. The conditional path is this. If the ceasefire holds and oil stabilizes below $90, the Bank of England retains the option to cut rates at its June meeting, and the mortgage market reprices lower by summer. If the ceasefire fractures and oil resurges, the bank holds. 5-year fixed rates stay above 4.5%.